Traders stare at flashing red and green numbers, reacting to sudden drops with panic selling. We replace that reaction with a set of systematic rules. Today, we will execute the strategy for perfect uptrend. By the end of this video, you will know exactly how to manage a trade from the initial entry signal all the way to the final exit. To do this alongside me, you only need two things: access to any standard charting platform and a blank spreadsheet. When you rely on objective mathematical indicators to dictate your moves, you remove human emotion. You execute exactly what the data confirms. Step 1 is cleaning up the data feed. Standard price charts display intraday noise that makes it difficult to read the actual momentum. To fix this, open your chart settings and switch the display to Heikin-Ashi candles. This comparison shows the immediate difference. The Heikin-Ashi formula averages out the price data. Notice how the erratic red and green swings on the left turn into sustained, solid blocks of green on the right. Do not overlay these. Leaving standard candlesticks underneath will clutter the screen and create conflicting signals. Now we apply our baseline metric. Add the 20-period exponential moving average to the chart. Here is our ideal setup: a tight cluster of green Heikin-Ashi candles resting right against the 20 EMA line. But if price accelerates too fast and candles float way above the 20 EMA, momentum is overextended. Buying here is chasing the trend. By establishing this visual baseline, you create your first mandatory filter. This ensures you only consider trades when price is grounded, keeping you out of exhausted rallies. A clean visual trend shows the direction, but it does not tell you when to enter. Before risking capital, we require objective confirmation from 3 specific technical indicators. First condition: the Elder Force Index must cross distinctly above the zero horizon line. Next, the parabolic SAR must plot its dots below the price candles. Finally, the MACD line must actively cross up over its signal line. You must check off all 3 of these conditions at the exact same time. The buy signal is only mathematically valid if the EFI, SAR, and MACD agree. Do not enter the market if only 2 of the 3 indicators align. Acting prematurely is the most common point of failure. Demanding a unanimous signal from these 3 indicators forces you to wait for strict alignment. You execute the trade mechanically rather than guessing about probability. With the entry confirmed, we immediately outline the exit strategy. You must define exactly how you will leave the trade before a single dollar is deployed. This composition illustrates the setup. Scan your chart for upcoming resistance levels, determine your target price, and type that exact number into your external spreadsheet. If you skip logging this number, you leave your exit open to interpretation. When the trade is live and the price is rising, greed kicks in, leading to emotional decisions instead of calculated profit booking. Sometimes the market will turn before hitting your spreadsheet target. If you are in an active trade, you must watch for a specific warning signal, the Heikin-Ashi doji pattern. This diagram shows exactly what to look for. Notice the doji candle right at the top, a compressed body with wicks extending on both sides. This geometry signals total trend exhaustion. When you see a confirmed doji, exit the trade. The psychological trap here is holding on, hoping the price momentum will miraculously recover. By anchoring your expectations to an external spreadsheet target and respecting objective candlestick exhaustion patterns, you manage the trade purely through data. We have now built the complete architecture for the perfect uptrend. You clean the chart using Heikin-Ashi candles resting on the 20 EMA, then you validate the entry with simultaneous confirmation from the EFI, parabolic SAR, and MACD. Then you lock in your exit strategy with a predefined spreadsheet target, stepping out the moment you see a doji exhaustion pattern. Now open historical data on your charting platform. Find and log this exact blueprint 3 consecutive times. Practice the sequence until the visual recognition and execution become completely mechanical.